Good morning, Mr. Garver. Can you hear me?
Yes, yes, I can.
Good. Got a new headset.
Good morning.
Glad it works.
Good morning.
Where are you today?
You know what,
Uh,
Robert? I was just going to say Rob needs to announce how loyal he is to us, and I want to hear him tell us where he is right now.
Right.
I am going to meet our team in person in the Philippines. I'm on the island of Cebu on
Wow.
my vacation, and you guys are joining me.
Oh my goodness.
Yep,
That's
and
great.
it's exactly 11 p.m. So I'm going to learn how our team in the Philippines. I see Mary Cohn on. So I'm living your time today. So it's exciting. So this morning, I wanted to wait for a little bit more of our group to get on here, but I'm going to talk a little bit about some creative ways to nudge the first-time home buyers market. And I see we only have 19 people on yet, so I'm gonna hold out for a moment or two. Does anybody have anything, any interesting success stories or anything you want to share before I get into the content?
Interesting success story. I'm not sure you have someone. Please think. Who's
No, no great success stories for this week to inspire your peers, huh? I will say to Mary Pack, I saw Pack's Coffee in Seoul, Korea. So maybe you're entitled to inheritance soon.
I wish. I actually have a lot of people send that to me when they're in Korea. I saw your photo,
Okay,
so it's amazing.
fantastic.
Is in
So, I
Korea?
wanted to just mention about following up with previous clients. Um,
Okay.
my last two transactions were with previous clients who called me and said, "Let's do it again," including one who just called me the other day, who's looking to buy a $2 million house here in Mountain Lakes out of the
C-
blue.
c- Congrats. Sometimes, Robert, it's mindset,
Yep.
I'm going to talk about that a little bit. And before we get into the heart of today's session, I want to say that sometimes we're too close to what we do that we need to take a step back and look at it. That's number one. And then number two is because we know something doesn't mean that it's properly positioned in our mind and our mindset. And what I mean by that is, does anybody know, or does anybody ever do incantations where, you kind of, speak to yourself in the morning every day or periodically just to keep your mind fresh and stay focused on the positive instead of the negative that creeps in automatically? Okay. Um, we need to reprogram our brain and not just take for granted things that we know. Because if we don't, then what happens is, sometimes we get to be a little bit sloppy, sometimes we get to be a little bit inconsistent, and we don't give our best version to every client every time. Okay. Because when we do this day in and day out, right, we probably go on autopilot with a lot of things that we talk about. But for the client, it's the first experience, right? It's the first time they're looking to buy a house, right? For us, it's the 129th time we had this conversation, maybe in the past 2 years, maybe it's 1,000 times in our career. Um, I think we owe it to ourselves to keep things fresh. And part of the gift that I get is when I prepare for this, it truly is a gift because it forces me to think about things and look at them from a different perspective and put them into digestible pieces so that you can take it and give it to your clients. Okay. So with that said, I think before we go into the mindset of selling homes, and this is a big distinction, we need to talk about um, selling home ownership, which is different than selling homes. And if I asked any of you, what's the difference between selling a home and selling home ownership? Does anybody want to volunteer and tell me, like, what does that mean to you? Because I can call them my favorites, And I'm looking at Lisa there with the big smile. Like, what's the difference between selling a home, Lisa Mouser VC, versus selling home ownership? Home
Sell,
ownership versus a home.
Selling a home is just the structure you're selling a home, but home ownership is all the benefits that come with owning a home, and all the advantages for your family. That's the difference.
Right. So, um, our
Such as,
industries, our industry's gotten so away from selling home ownership, we just assume that we're selling shelter, not home ownership. And if you look around the rest of the industry, Lisa, maybe even, because I'm certainly guilty of it, but maybe if you look around and you say, hey, we've gotten into the technology, we've gotten into the bells and whistles of selling homes, but we've neglected the home ownership piece. Is that possible?
yes, possible.
Right? And before, if you ever have somebody that walks away from a transaction over, 2 or 3% of the price, so if it's $500,000 home, if they're walking away from it for 10 or $15,000, there's a good chance it's an emotional walk away. That's because they haven't fully bought into home ownership and what that means, as opposed to, what does 10 or 15,000 mean? We talked about a couple of weeks ago that, the commission that they pay us, they don't remember that in 2 months, 2 years, 10 years. But what they do remember is they remember the process. They remember, was it stressful? Did they have their closing numbers beforehand? When issues arose, did Lisa take care of them or did she go into panic mode? Right? Did she surround herself with people that would make this experience um, a more memorable in a positive way, as opposed to me going and saying, "Hey, Glenn Baker, buying a house, it was great, but it was so hard. I had all these problems, and everything's last minute, and it's just like it's the Wild West." You don't want that experience, right? You want to have a positive experience that people go away with. And in terms of, if you really get them into the concept of, I want to be a homeowner, I understand the benefits. Okay, those small differences don't separate them from the home that they want, and walking away from it emotionally. Okay. And I think that's a big nut. It's not about, and at least don't get me wrong, it's not about making this easier for you to make a sale, because you know what? When you get in the right mindset, it doesn't matter if they buy this one or that one. It doesn't matter if they're committed to buying a house, you're going to show them the path, but they have to first be really committed to buying a house, not just looking at the alternative to renting. Does that make sense? And you know, part of this concept in my mind is, instead of talking about the shelter and comparing payments and, hey, this is tax deductible, maybe we ought to just focus on how it can impact generational wealth, and by asking better questions like, you know, the obvious question is the net worth of a homeowner versus a renter. To me, that's the easiest pitch to separate people, right? And there's probably very few people that are able to buy a house without having to make some sacrifice, right? In other words, you can't take 7 vacations, order Uber Eats every meal, and then complain about not having money for a down payment, and it's tough to buy a house. They have to see the benefit and then want to make that move themselves. Okay. And to me, that's, having them buy into home ownership, having them know the cost of waiting, having them stop the clock on the buying process, right? And, if you don't know, I started out in this industry as a lender, and I don't think I ever went back to an agent, an attorney, an accountant, a financial planner that referred a client to me and said, "You know what, Lisa, the people you referred to me, they can't buy a house. I'm sorry, bye." Right? It was always, the good news is, Lisa, in 6 to 9 months, they'll be able to buy. I gave them a plan. Okay, whether they execute on that plan or not is up to them. But like, that's just the mindset that I had, because virtually everybody can come up with a plan, even if the plan is, you have to stop being a independent contractor and get a real job, or you have to declare more money on your tax return, or you have to get your credit fixed. These are all processes that were able to be effectuated if the client was convinced that home ownership was for them. Does that make sense? All right. I want to see, do we have any lenders on? Is Frank on? Because I saw something earlier that I wanted to just get some clarification on. Frank Delpesh. I see we have Mehdi, we have Frank.
How are you?
Uh, good. So, Frank, did I see something about condos having a big pivot this week with the agencies? And is it only Fannie or is it both?
So there's been a major change in the condo market, both Fannie and Freddie. It became effective Monday, August 3rd. And the big changes are that with 20 or 25% down, 20% out of Florida, 25% down in Florida. Fannie Mae required a limited condo questionnaire, which basically was a 2.5 page condo questionnaire, just asking some basic questions about the complex. Um, and that was the limited questionnaire. The full questionnaire is a 4 or 5 page questionnaire that asks a lot of questions. Fannie Mae and Freddie Mac have both eliminated the limited questionnaire. So now that opens up a can of worms for the condo market. So now not only do we need the budget, the bylaws, the balance sheet. We need a lot more documentation, regardless of how much there is that the clients put down. So no more limited questionnaire. Everything is going full questionnaire. So that's just going to open up with the special assessments, any lawsuits. It's just going to open up a can of worms. So it's going to make the condo market a little more challenging. So
So,
my
so, so
suggestion,
let Frank, let
go
me
ahead.
interrupt you just for a second. Are they also requesting the minutes from the meetings where they're looking to see if there may be assessments coming up?
Assessments. Yep, absolutely. Yeah,
So,
they're
so
all,
they're being very they're being very
yes,
diligent and
very
conservative in the
diligent.
underwriting. And I just want to share with everybody exactly what liquidity means to a market. Okay, because if you can buy a place with 3.5% down, or if you need to put down 10% or 20%, the amount of people that can enter that market is probably, every time you increase the down payment by another 5%, probably takes away a third to the half of the public that can afford to buy that property, right? So if you have a condo and there's, 50 people that can afford to buy it. Now you increase the down payment from 3.5% to 10%. You probably only have, 20 or 30 people that actually can afford to buy it. And now what Frank is saying that it might be going to 25 or 30% in some of these particular condos because the borrower could be perfect. However, the condominium itself has some defects according to the agencies. Am I summarizing that correct,
Yep,
Frank?
exactly,
And
exactly.
and and in my experience, if you see that the market's constricted, like you're now making it even harder for first-time buyers with lower down payments to enter the condo market, then that means that the prices are going to be compressed and pushed down, right? So it's going to be worse for your condo sellers.
It is, yeah. And and I mean, like I said, it means that the condo projects that previously qualified under the streamline review, it's going to be a much more detailed full project review. So what it means for the buyers is more HOA documents will be required regardless of the down payment, more scrutiny on reserves. And let me just talk about reserves in a minute. The insurance, the deferred maintenance, like you said, the litigation, the project financials. These are all things now they have to look at where when we did the limited review, they don't have to look at it. So it could be longer underwriting timelines in some cases. I mean, it's just, it is. It's going to be a little more challenging. So my recommendation would be, before you write an offer or whether you're taking a listing or selling it, let me review the condo project. I can review the reserves, the insurance, the litigation, if there's any deferred maintenance. We review all these documents before you submit that offer. Like I said, it's going to be a little bit more challenging and it could take a little more time, but I'd rather know up front if the listing, when you list it, you got to tell them it's a non-warrantable condo now when it wasn't before, and the same for the buyers. So my recommendation is submit the documents, we can review it, and that way you have a better understanding whether you have to put 5% down or 25% down.
And Frank, the good news is there any good news?
The good news is rates have come down a little bit. So,
But but
not,
but
no,
but but, but Frank, don't keep it a secret because I know that you're always I'm going to talk about this a little bit later on, but you're always playing chess instead of checkers, where you're not worried about this move, you're worried about like
nope,
two moves down, and you being part of Motto have access to basically unlimited number of lenders, and
unlimited.
there are lenders that will do unwarrantable condos, which is the good news, correct?
The good news is I have a lender for everybody, whether it's a non-warrantable or a warrantable. That is the good news. So we can get condos done regardless. Like I said, it may not be a big deal. It may or may not, but why don't we get the information up front, review it, and we'll have a better understanding which way we can go. But yes, the good news is we do have lenders. I do have investors for every type of project. The only other thing that I do want to talk about is the reserve requirements. Fannie and Freddie used to have, well, they still do. There's a 10% reserve in their budget that they require. As of January 2nd of 2027, that reserve requirement is going up to 15% in their reserve account. So again, they were giving these condos enough time to review their budget and make those adjustments to become Fannie and Freddie eligible. So let's just make sure that we review these documents up front and get everything out, and that way we know which direction we can go, whether it's non-warrantable or warrantable. We'll get the deal done.
Right. And for those of you who don't get too involved in the financing, you have your lender of choice, you refer to them and they take it from there. I would say probably at this point in time, it's got to be north of 80% of condos that are financed through Fannie or Freddie guidelines. Would you agree, Mehdi or Frank?
Mhm.
Even if it's a small bank, they're underwriting to the Fannie or Freddie guidelines because
Always.
they want to have that paper as being liquid so that they could sell it at some point if they had to.
Right.
Correct? So this
Absolutely.
impacts almost everything,
Everybody. Yeah.
right? So having this information ahead of you, and Frank, if somebody was in the process, right? Do they have a certain amount of period to close, or it's game over as soon as this rule changed?
Starting August 3rd, Monday, the
So
new
if the
guidelines
loan,
went into
it,
effect. But
so
if the
if the
loan is
loan's
in
not,
process already,
yes.
you're in process already.
So if you have,
Any loan originated after on or after August 3rd. I have projects right now that I'm working on that I submitted last month. It doesn't affect them, but it does affect new applications moving forward from August 3rd.
okay, so if you have somebody buying a condo,
Or even
they're
listing,
thinking,
or taking a listing.
yeah, they have a condo under contract and they're bickering over $2,000 to get to the closing table. Know that that next buyer that comes in August 4th and beyond is going to have a different set of criteria, which might impair the value, or impair the terms for the buyer, impair the value for the seller. So forewarned everybody. Um,
Can I just ask a quick question? Does so when we're taking a listing, do you still check the box conventional? So
Uh,
conventional's okay, or
well, it
how do you
could
do that?
go. Yeah, I mean conventional because yeah, if yes, you can, but again, we don't know. You may have to put 25% down going
right,
conventional, and then again, the
right.
building, even though the buyer would qualify, the building may not.
So this
So,
doesn't
but
affect FHA or VA though. Those are different funding.
They're different. Yes.
yeah,
Okay.
those are typically even harder though, right, Frank?
Yeah, yes, I'm running into an issue right now with a dishonesty fidelity insurance that FHA requires. I got the project FHA spot approved, but now that we're going back and forth with the insurance for some dishonesty policy, some fidelity. So FHA is a little more strict, and VA would be the same.
They have to be approved already for those loans that,
Or I can get a spot approval. If they're not, I can get a spot approval. I can
okay.
request a spot approval.
All
Now,
right, good.
now, now, this is not what I want to make this session, but if Fannie or Freddie has an association approved, Frank, and then, for example, the reserve requirement isn't met, but they're already approved, you still need to get a questionnaire done if they're approved, or how does that work?
Still, even though they're Fannie Mae approved currently, effective August 3rd, we have to do the full review. And now we need to see all of their documentation. And they're going to scrutinize it and they're going to look at it, deeply. Again, it's not going to affect everybody, but it's going to have a bigger effect than, previous.
And then if there is litigation or a shortage in the reserves, that means that no FHA financing, even with 50%, or no agency Fannie Freddie with 50% down. There's no waiver. Every single deal gets the full review, Frank.
Scrutinized. Everybody gets scrutinized.
Okay, there you go. There you have it.
Yeah. Yeah. But again, if it's 50% down, you go non-warrantable, well then there you go. That's an easy fix. So it may not go Freddie or Fannie, but it can go non-warrantable. 25% down non-warrantable.
All right. Well, it kind of brings me to challenges often are the seeds of creativity. And one of the things I wanted to take a look at today, which I had a little bit more optimism about for first-time buyers than I did after doing a thorough underwrite of this option, is these home appreciation sharing opportunities through Fintechs. If you're on camera, have you ever heard of those? Raise your hand if you heard about them. I mean, there's only probably about 3,000 done a year, so it's very possible that you haven't. But there's a there's about 5 or 6 companies that have specialized, and there's almost 20 years they've been doing this, where instead of doing a home equity loan or a second mortgage when you buy, what they're doing is they're doing a home appreciation share. Okay, so the big framework for this is, let's assume that you wanted to buy a house for $500,000, right? And you had 10% down, but with the PMI and the extra 10% that you have to borrow, it kind of crushes you out of affordability. You don't qualify to buy this house. So there comes along a creative solution through FinTech. And believe it or not, I think the first one came out in 2006 or 2007, almost 20 years ago. And these companies used algorithms to determine that, hey, instead of me giving Frank Delpeche a second mortgage that he has to make monthly payments on, or at least pay the interest on, that also counts in his debt to qualify for that property. We're going to come up with a different concept. We're going to do a home equity share. So we'll give Frank $50,000. Okay, we're going to take 20% of the appreciation of that property, or we'll even take 20% of the loss if the value goes down, um, and help him to buy houses that he otherwise wouldn't be able to afford. Does everybody understand at least the overall concept of that?
No.
No. Okay, I'll explain it again. So, when I started out as a lender, if you put down less than 20%, you had to pay PMI. There's a creative solution that came out which gave you a first and a second mortgage when you bought a house, which is very uncommon. I don't know if anybody's done one of those in the past 2 years. My guess is that we have over 50 people on the call. There's probably nobody that's done a first and second purchase money mortgage. Frank, have you done any of those in
80,
the
10,
past year?
10s, yeah, 10% down, 10% second. It's a 20% down payment, no PMI.
You've done them in the past year, or have they been
Yes. Oh no,
okay?
they're still around.
So they're still around, but they're not as robust as they were 20 years ago.
No, not at all.
So instead of doing an 80, 10, 10, that 10% second mortgage is usually priced at a higher interest rate, right, Frank? And sometimes it's even priced at like a variable or a balloon product. So qualifying is more difficult. So along comes this fintech company that says, hey, we're going to share in the equity with you so that you don't have a monthly payment. It's not even a debt. So we're going to wait up to 30 years in some cases, up to 10 years in other cases. And we're going to say, hey, if your home has appreciated in 10 years and you haven't paid us off, then we just get an appraisal and you owe us the difference and you need to refinance. Um, but when during that 10 years you have no monthly payment, okay, you don't have a second mortgage. It's kind of hard to understand, but if you buy a house for 500, you only have 50,000 to put down. This fintech comes in, gives you $50,000. There's no mortgage payment as if it was your down payment. The only difference is when you sell that property, they get 25% of the appreciation in the property plus the money that they lent you. Interesting concept. I think it's a very niche product right now. I was optimistic might be better. I was even hopeful that we could stack it with like grant money, which is more available now than it's been. And I think we go out 12 months from now, we're going to see more grant money available because home affordability is a political football that both sides want to solve for, right? I don't think, Democrats, Republicans, independents, they all want to see more affordability on home ownership. Okay, that's like a universal principle because the um, the vibe is their constituents are having a hard time buying properties because interest rates are high, prices are up, and they're really put into a pickle. So I would say that we're going to see more of that going on in the future. Um, the government can control that. They really can't control interest rates. They can control short-term rates, but they really can't control the long end of the mortgage rate market. So before I move on, if you don't understand, I'll explain it one more time. Does everybody understand what a home appreciation fintech does?
Yes.
Okay.
Yeah.
And
Yeah.
who thinks that that would be a good idea or a bad idea? I see Robert, you raised your hand.
Well, I raised my hand because I was just wondering if you could just explain the term fintech.
I thought
Um,
fintech was like Venmo. Venmo's a fintech.
Yes, that's
so
that.
I think a fintech is just a combined financial technology company. Okay, so a fintech might be like Plaid, right? I know for when we have business loans, instead of having to resubmit all my documentation every year, what they just do is that, um, hold on, sorry. Mary Cohn, if you're a co-host, if you could just mute people when that happens. So what a fintech is it's a financial tech company, and one fintech platform that I'm familiar with is Plaid, right? And what Plaid will do is when a business loan is reviewed, and they review them periodically, they'll just ask you to log into your bank account, and they'll look at your deposits, your expenses, and they won't go into all that underwriting. It's a technology product in the financial world, so that's the fintech. And here, the fintech is like an actuarial, Robert, where they're saying, hey, over time, homes go up in value. We see that benefit. If we can get a percentage of the increase in the home instead of interest rate, we think we might be better off. And we think there's a place for a homeowner to benefit from that as well. So if your home doubles in 10 years, you probably paid more than interest. If your home is, going up 2 or 3% a year, you might wind up winning with this type of a product. But I think the essence of my review was purely on affordability and helping people have additional options for them to consider, right? And if nothing else, if we could articulate to clients that here's an additional option that nobody explained to them before and said, hey, here's plan A, here's plan B. Which one do you feel is right for your risk tolerance where you're at, right? And if it meant buying a house for 600 versus 500, some people might say, hey, I really need that bigger house that I don't need to put in 50 or 100,000 once I buy it. It's better for me personally, then maybe that's the only solution for them, right? And if they understand how it works, that's fine. I mean, if you taken one of these products out in 2020 and then you sold it in 2023, that you probably paid a lot more than you would have for interest. But there are other times where you might have made out better. I'll give you a news flash. I don't think it's going to be as significant of a player as I thought. And, I'm going to, go and say that once again, the lenders and their conservative approach are going to make it more difficult because if the fintech came in and gave you 20% uh, down payment, the lenders are generally requiring that you have 5 to 10% of your own money anyway. And I believe most of them are going to require you to have 10% of your own assets into the purchase price. I don't know, Mehdi, are you still on? Or Frank? Anybody?
I'm still on.
So Mehdi, if you if you get a grant from your employer for 15% on a conventional, do you still have to have your own 5%, or can you get that money as a gift, or does it depend on who you're
Yeah,
placing it with?
you don't need your own 5%. You just have mortgage insurance. But if you get another 5% gift, you wouldn't have mortgage insurance. But generally, the grant's enough to cover the down payment.
Because in the limited research I did, they were saying that for an agency product like Fannie and Freddie, if the home equity fintech were to give you the full 20%, that you wouldn't qualify for the mortgage because you don't have enough of your own skin in the game, your own assets into the deal. I don't need you to give me an answer on that today, but I think that's you can't get in with no money down with these fintechs. So
That's
that's a
probably true. That's
challenge.
I'm sure it's accurate.
So so anyway, those are some of the things that were in my head, but maybe limited. So there may be very fringe cases where these really provide benefits. I do know that you can stack these with grants. So in other words, if you got a 10%, home appreciation fintech transaction, you put down 10% yourself and you got a 10% grant, you're basically like putting down 30%, only mortgaging 70%. So the affordability comes up tremendously. Okay.
I have a question.
Yes.
Can an investor use this as well, or can it be used in a multiple family dwelling?
So, investors can use it. Terry, more commonly, investors are using this for pulling out cash to buy another property. Okay, because a lot of times it's hard for an investor to get a second mortgage or to do a cash out loan on it. And these fintechs do play a big role in giving the ability to like buy your next house from the appreciation in the house you bought 3 years ago. Okay. And to make it even better than that, if you bought the house for 400, it's now worth 550. You're not going to be paying the fintech that first 150 that you've already appreciated. You're only going to pay on future appreciation. So there is a case for that. Um, but being said that, a lot of what I'm focusing on is trying to make home ownership affordable. It really, in my opinion, falls short in many cases. The only case I see that really plays a role is if somebody has 10% down to buy a house, they're stretching, right? Their ratio is, you know, 40. Again, lenders, with the 10% and excellent credit, your back ratio can be 45 or can you go up to 50 with a
Sometimes 50 would be the max if they
okay,
have
so
great credit.
let's say somebody with great credit, they're at a 50% debt ratio and they have PMI and they're borrowing an extra 10%. This would get them the house that they really want. That extra 50,000 plus no PMI would probably get them 75 to 100,000 more buying power. Um, so they get the house that they want. To me, that's the most likely fringe case with these fintech companies. So don't spend money on having an extra four transactions this year because of this one solution. This may be one transaction in 2 years that would fit the void here, and it does require some homework to get to that point. But I want to kind of go back to the home affordability and the selling home ownership and the incantations that we can kind of tell ourselves because if you go to a concert, right? Your favorite artist, you go to their concert, and I see Glenn, you're an Ed Sheeran fan. There are people who go to an Ed Sheeran concert. It's the first time they've ever seen him. And if he has an off night, forgets to play a song, that would probably be very disappointing. And for our clients, we need to bring the best version of ourselves so that we can give the story the same way every time. And the only way we do that is by keeping ourselves to be fresh and positive on this. So selling home ownership, I would focus on the wealth impact, not just the monthly cost differential, right? And the whole package of home ownership, which I could probably talk for 45 minutes about. And, Terry and some of you had done these buyer events where we talked to them about the benefits of home ownership. From kids doing better in school because they move less. There's just so many generally homeowners are in safer neighborhoods. There's so many reasons why we should be having these conversations about home ownership before we even talk about, hey, what properties for sale? Okay, that's a huge difference. And then we need to key them in on the wealth impact, not just the monthly payment or not just the freedom, right? And I think, Glenn, you probably know the statistics. I delayed buying a house for 5 years. What do you think that cost me in Boonton or Morris County? How much lost amortization and appreciation do you think I forego?
5 years, probably 75,000, $75,000.
Right. So it's a huge number. And if we're not having that discussion with the buyers, it seems quite innocent to wait a year or two, doesn't it, Glenn?
I would say so for sure.
So, if you have those hard facts, right? I mean, how many people without extraordinary effort are going to save up an extra 75 grand in the next 5 years by waiting? So whatever they're saving, if they can save 10,000 a year for the next 5 years, they scrimp, they sacrifice, they don't live in the house they want. They do that for 5 years, they save up 50,000. Their twin brother or sister who bought the house today just saw $75,000 of appreciation without having to scrimp and save that extra money. So those are conversations that I believe every buyer or potential buyer needs to at least have at their disposal so that they can make that choice themselves, right? And I know that if Glenn or I were trying to convince somebody that, hey, don't wait because you're going to lose this, it comes across differently as if we're just making sure that they're aware of what deferring a decision means, what kicking the can down the road means to you financially. Okay. So, um, you know, look one or two moves down, right? If you defer buying, right? If you're going to be in the house for 5 to 7 years, when you want to buy your next house, how cool would it be, Glenn, if you had 300,000 to put down instead of 70,000 that you have now, or whatever the down payment is, right? Calculate those numbers so that they feel comfortable, right? And one of the things is once you get into home ownership, if prices go up like the stock market has been, right? Your home that you're in that you're going to sell is going to go up tremendously. You're going to be levered in most cases, 80 or 90% leverage. So that means that you're getting all that appreciation on the limited down payment. It's just astronomical. So that's where, I think we need to change the discussion, change the whole context of that first meeting that may or may not even exist today. I know years ago, Mr. Garber, when you started out and when I was started out, when somebody was looking to buy a house, didn't you usually meet them in the office first, right?
Yes.
And you'd have a conversation. It might be a consultation. You get to find out, a little bit about them, talk to them about the process, try to, give them that education, which now seems to be sorely lacking because the customers go on, Redfin, Zillow, Realtor.com. They think they know everything and they just say, open this door for me, right? And many of our peers, we answer the phone and we run and we open the door, right? We don't even do the litmus test. We don't even give them the courtesy of what they need to know. They don't think they need to know it. In almost every case, they don't think they need to know it, but I do think they need to know it. Does that make sense? And I guess I'll phrase that to you, Robert,
Yeah,
because
yeah, no,
you've seen a lot of different markets. You've managed people, you've seen it, you've seen the changes, you've adapted to the changes.
yeah, and my point is, look, you tell me a list of properties you want to see, and if I can, I want to save you some time by now. If I know that you don't want a pool in your backyard, but two of the houses you say you want to see have pools in the backyard, I want you to know that before we go out, so that, we don't waste your time. So I think it's important to get to know the people before we just run to open a door. And because, if we run to open a door, they're calling somebody else to run and open another door who's going to meet them right after they're done with you. So we're not establishing any kind of a relationship, or, business agreement with these clients if we don't meet with them first.
Yep. So, again, sometimes the business throws us curveballs, right? We think we're doing what we should be doing. We think we're being responsive. We try to return our phone call in less than 5 minutes. We try to take care of the client. But sometimes that behavior just enables um, um, the clients to miss the real value proposition that we have, right? Our real differentiator, which is, having that conversation. If you've ever pulled your hair out because somebody's walked away from a deal over a few $1,000s in the initial negotiations, you probably have taken a look back at it like I do and say, they don't, they don't even know how little that is that they're walking away from this property. And some experts have been like, hey, let's just tell them that's only a cup of coffee a day. You can buy it for the extra 10,000. Has anybody ever heard that analogy, right? That's $3 a day more to buy the house that you want. And many times that doesn't work, right? And I believe the reason why that doesn't work is because they really haven't fully bought into home ownership. They're just looking at it as shelter, and they're putting an emotional barrier on it, maybe because I'm not going to pay more than 500,000 for that, because that's a big round number. But it's just very arbitrary. And if it's the house that's right for you and you have the person that you trust to negotiate, probably it's most times than not, it's probably a mistake. Would you agree, Robert? Like when somebody
Yeah,
draws a line and saying, "Hey, I'm stopping at 500." And have you ever had somebody call you up later on and say, "Hey, Robert, if I would have known I could have had that for 520, man, I'm so upset." Have you, on this Zoom meeting, if you've had that conversation more than once, shake your head, because you've had clients that after it closes say, "Oh, Glenn, if I would have known I could have had that for only 30,000 more, I would have easily paid that, right?" And you're like, "Not when I was talking to you, you were a different beast. You weren't going to pay a nickel more." But then after the fact, it's easy to play Monday morning quarterback and say, "Wow, for 30,000, I could have had the house I wanted. I could have had the corner lot. I could have been in the town I wanted. I could have been in there 6 months sooner." And again, I think it all comes down to not selling home ownership before selling homes. In order to effectively sell home ownership, we need to be the first person that's convinced. And maybe we need to, have, incantations. Maybe we need to just revisit this ourselves. And I'm not saying in a corny way to brainwash ourselves about home ownership, but to just kind of go over the same things, because we do this concert every night, right? We don't want to forget the best hits. We don't want to forget to play the best songs. And if we're not consistent with all of our people, we don't believe that we need to talk about the principle of changing our identity from a renter to a homeowner, what that means not only to lifestyle, but our financial well-being. And not only is it just this first house that is grossly insignificant, grossly misses all the check marks that we want, because nobody ever gets the perfect house the first time for sure, and few people ever get it ever. But the fact that you get started, right? That's the first move in the chess match. The second move is, now that you're in, you're building up equity. Now you can determine when you want to make the next move, correct? Because you have more options when you have equity, when you have a hard asset, right? That's building on appreciation. You know, has anybody ever gone through an exercise with a home buyer that's putting down, like, let's say 5%, and said, "Hey, if homes appreciate 4% for the next 5 years, do you know what your return will be on that down payment?" Has anyone ever done that? No, right? But if you have somebody putting down 5% and the homes are going up 4% a year, that's an 80% return that's being compounded. Forget about all the tax benefits, right? Because if you compared that to, if you put down 50,000 and you get a 4% return, you're getting $40,000 of appreciation on your 5% down. You're at 50,000 down, you're getting 40,000 of appreciation annually. If you had 40,000 stock profit, you have to pay state and federal tax on that. If you have this on your home, you pay, in round numbers, zero, right? And have them calculate that, and then have them talk about how they parlay that into their next home, right? I mean, I would say a lot of homeowners don't understand the difference between deferring a gain and realizing it and increasing their basis in the second home that they buy, right? And those are things I think that part of the foundation to get people more engaged in becoming a homeowner, playing chess instead of checkers, um, playing your best show every night, to give you an analogy. You know, if your favorite band comes into town for two shows every 5 years and you get to catch one of them, you best hope they put their best act on, right? You don't want to have them have a bad night because you paid the same price as the good night. So, if we're not first convinced, if we're not, and we're not selling, we're educating, and if when I get to know so many of you on a personal level, I know how personal this journey is for you. Many of you got into this business because you were disappointed in the services that you were provided for when you were looking to buy a house. And if that's you, raise your hand. Like if you literally got in this business because you bought a house and you're like, wow, that's all there is, I bet it's at least 10-20% of the audience here said, wow, there's so much more that we can deliver to a buyer or to a client in this process. So, has anybody, I had a couple of really good stories in the past month about grants that the people have secured for their clients. Anybody on this Zoom done any good grant activity for first-time buyers or buyers?
We have.
And are you saying 15 to 25,000, Glenn, is the grant range?
15 was what ours have had. And
Mine
also
was 20, mine was
concessions.
22.
22. And Kathy, that was a relative of yours, right?
Yep.
So I think I did have that one in the back of my mind. I saw that come across, which big congratulations to both of you. But tell me a little bit about that journey, Kathy. And was that a cousin, a child? Who was that, and how did it feel to give them free money?
It was a niece, and she and her husband barely had $25,000 to put down and to utilize without going their into their 401k plans. And so I was able to hook up with a local mortgage rep who specializes in grants. And because her husband did not have a legal address for so many years of his life, he was able to get $5,000 more than what they were able to get. So it wound up getting $22,000 and they were able to purchase at 600,000.
So that's a reasonable starter home for sure, and that's some good math that you did there, Kathy. So hopefully that inspires you to spread the word.
I'm already using that same mortgage rep for another three people, and we're working out trying to get them anywhere between 15 and 25,000 as well.
And was it a single grant or were there multiple?
It was a single grant.
And county,
NJF
state, NJ,
County,
okay,
NJFMA, yeah, HMFA.
FMA, fantastic. Anybody else utilizing the grants to help their clients? And did it take a lot longer to get it done, Kathy?
It took actually 2 weeks longer to get it done, but
Okay,
it was well worth the wait.
and Glenn, are you seeing extended close times for that and sellers that are resisting structures like that?
No, because you're usually doing it in our market in a disadvantaged seller situation, so you take advantage of it. But it's about 2 weeks longer as well, same time frame.
Fantastic. So, let's try to stretch our resume and put a couple more of these under our belt and take care of some clients. I can see that it really does well for your client, and it also seems to make both of you feel pretty good about the service that you provided. So, congrats.
Yeah, and Rob, I just say it recasts the story, right? Because anyone who knows our market, it's hot, right? And in Bhutan, you can never buy a house for less than X number of dollars or money down. And in this instance, we got them into the house with $1,000 out of pocket, not veteran, because of concessions and other things that came about. So if you think you can't do it in any market, you're telling yourself a story. It's you, it's not the market.
Yeah, I think again, it comes down to a little bit of mindset, right, Glenn? If you think you can, you think you can't, you're probably right.
Yep. Mr. Ford.
Yep.
Rob, there's still a lot of FHA down payment assistance programs too, where, like Glenn said, you get in with like $1,000. So there are the FHA grant program, actually investor specific programs. A lot of our investors will give out, 3.5% as their down payment. So there's a lot of different programs that are out there that, whether it's a grant or an investor, there's money out there to be, to be lent.
Yep. So I'm gonna just kind of randomly poll. Brian Neugebauer, when your clients buy, if they say, this is our 5 to 7 year house, um, are you assuming that they're going to sell it in 5 to 7 years, or are you giving them the option to rent it? Like, how does that conversation happen with you in Arizona?
I'm looking at them selling it. Kind of what you had mentioned in regards to building equity, kind of moving up that equity ladder, kind of moving into that position.
Okay. Maybe even having a conversation about, hey, in 5 to 7 years, you could also cash out, put the money down, and you can start to build a portfolio of real estate as well. Maybe it's not as good for your sales numbers that year, but I've always found that if you educate, you do the right thing, that the universe pays you back with huge dividends. That's just my belief. But you could have somebody that owns 4 or 5 houses, and this could be the school teacher and the police officer worth $10 million, and they're going to refer you tons of business because you've made a massive impact in their life.
Right.
You know, and I think the conventional wisdom is we talk about in 5 years, you sell it, you take the money, you move out. And the good news is, Brian, most people aren't programmed to be landlords, especially those in New Jersey with the laws being a lot more complicated now. Right, Kathy? You need an attorney to interpret how you can evaluate a rental, but I do think it's good that we could share that information, and maybe even to the point of when you're buying the first house, maybe you could talk about, hey, before you have kids, maybe you buy a two-family, right? You buy it with FHA, or you buy it with minimum down. And then you have something that will cash flow and they can support your next house. So you can buy, instead of a 600, you could buy $1 million house, not because you have more money down. You could take cash out of your two-family, and then you could have the revenue coming in to make the payment on your $1 million house as if it was a $300,000 house, because you have 2 units paying rent. Those are like the conversations that I would encourage us to have, and look at that second move, even when you're buying the first house, right? Because hey, when we're looking to buy a house, do you want to buy something that is um, imminently rentable when you decide to move to your next property, or do you want to buy something that is just suitable for your lifestyle and is going to have reasonable appreciation to put more money down in the next house? It's kind of providing an extra level of service that most of your peers do not provide, in my opinion, right? And you know, not to be petty, but I'm going to go to the leadership team when we have our leadership meeting for all the different markets that we're in, and see if they could have maybe some role playing groups to up our skill on the conversation of selling home ownership, like the benefits of that. And obviously, it would be voluntary, but I do think that it would give us the opportunity to add more value to clients by having a conversation on a different level. Because if you started to talk about, is home ownership right for you when they want to see a house, they'd be like, wait, what are you talking about? I just want you to open the door, Kathy. Don't talk to me about that. And then when you start to educate them, they're going to be like, oh, wait, tell me more. I hadn't thought about that. And one of the key phrases that I love, and if you get to see them in person, you say, Kathy, has anyone taken the time to share with you, right? Because the answer is always going to be no. And they're going to feel like nobody else cared to explain that to them, right? Kathy, has anyone taken the time to share with you, the 7 financial benefits to owning a house? And you make it specific. Or, hey, Robert, has anyone taken the time to share with you the 3 distinct options you have when you put your home on the market? because nobody's doing that, right? Everybody at best has one, and most times they're just running to open a door and hoping that you'll pick them, right? You're kind of hoping that you'll get lucky and they buy that house that you showed them, not that you built a relationship where they're going to work with you regardless of a buyer agency agreement. The buyer agency agreement is just an afterthought because why wouldn't they work with you, period, right? And signing the piece of paperwork is just a formality. Okay, it's not a challenge. And that's kind of playing at that next level. That's kind of trying to change the market instead of just sell another house. When I did the Keys at 33 Paris challenge, if any of you know what that is, the principle wasn't to steal buyers from our competitors that we're going to buy anyway and sell them a house by having better follow-up skills and techniques. The concept was to open up home ownership to a whole nother audience, right? And to strategically bring down the beliefs. And I think I saw a survey where they said, I want to say that this was a NAR survey or it was the Federal Reserve Board did a survey and they asked non-homeowners this question. They asked it 5 years ago. They said, in the next 5 years, are you planning on buying a home, right? And 5 years ago, it was 41%. Do you know what that number is now when they ask renters, non-homeowners, in the next 5 years, do you plan on buying a home? You know what that number is? From 41%, you know what it's down to? Anybody want to take a guess?
20.
19%. Now, to me, and those of us, I see Cindy Reddy, those of us who have been in leadership, Kathy, you know, that's a sad state that people are so down on the prospects of buying a house. And I get it. There's a war, gas is high, inflation's higher. There's a whole lot of headwinds that prevent us from being easy to buy a house. And, the rates have gone up 2.5 times from these artificial lows that they were at. But honestly, I don't feel like I'm a victim of that. I feel like that's a war cry for me to go out there and get the message out and to help people realize that, home ownership is within reach. And it's not whether the home ownership's within reach, it's, you have to align yourself with somebody who can help you understand the process and get to the outcome that you want to get to, right? So if the average number is, hey, maybe 40% of people renting want to buy a house in the next 5 years. To me, that sounds about right. I still think it's low, but I want to make a difference. I want to have an impact on that by having more conversations, by educating people and not letting them feel like they're defeated from social media, from bad information, right? Because there's a lot of ways that you can accomplish that. Glenn says somebody bought a house 500 or 600,000 with only 1,000 down. Kathy, you got somebody $22,000 grant when they only had 25,000 to buy a significant first home. These are things that we should be doing, and we need to be having those conversations. I think it's partially our responsibility as an industry, not us individually, but as an industry, we need to change the narrative from clients and buyers that feel helpless and victimized by higher interest rates and prices that have gone up. So anyway, I'm 1 minute over this week. Pretty passionate about changing the way the business is done, having better conversations, giving people hope, and better yet than giving them hope is giving them a process to get to where they need to be. So hope you all have a great weekend. Signing off from Cebu in the Philippines. Take care, everybody.
Thank you.
Bye bye.
Bye bye. Enjoy your trip.